So first of all, welcome. It's wonderful to see you all here. Thank you all for coming. It's absolutely brilliant. And I know you know it's going to be a great talk, but it is very nice to see everyone. And it's lovely to have so many people at a 3CL event. And you are just the ones in the room. There are also some other people out in the ether from, not just in Cambridge, but from all over the world, virtually joining. And no doubt we'll hear from them later on. So I'm Louise Galliffer, for those of you who don't know me. I'm one of the co-directors of the 3CL, and Felix Steffek, who's sitting at the back, is the other co-director. And today we welcome Ignacio Tirado, who is Secretary General of UNIDROIT, which is the Institute for the Unification of Private Law in Rome. But he is also a professor at a university in Madrid, which I'm not going to say in Spanish because it'll be embarrassing. So I'm going to call it the Autonomous University in Madrid. And he is, among many other things, an insolvency law specialist. So just picking out a few highlights so that you know what he's going to talk about comes from. He's worked for the World Bank and with the IMF and been involved in insolvency law reforms in about 20 countries or more. He's written very widely in the area. He co-wrote with actually some of the people who are joined us online and others a book about a modular approach to MSME insolvency, but he's also written very widely in other areas. And he's, among other things, he's a member of the EU Rescue group, expert group on insolvency and restructuring, but he's done lots and lots of other insolvency work over the years. Now, our online attendees, just a few housekeeping matters. Please mute yourself. Perhaps you can't. I don't know, it's a webinar, maybe you don't need to do that. But in the Q&A, if you could, which there will be time for Q&A, please use the raise hand function if you're online. If you're in the room, obviously, please raise your hand. And I'll try and moderate you both equally, as it were. But for the online people, we will upgrade you to a participant, and then you can ask your own question, because it seems a bit silly to just write it down and then me read it out. We are recording the session, but we won't record the Q&A, we never do. And therefore you can say exactly what you like because it won't go down for posterity. Okay, so I think I'll now hand over to Ignacio and come and give this talk.
Thank you. Okay, well, first of all, thanks so much to Professor Galliffer and to Professor Steffek, to Louise and Felix for inviting me to this most prestigious venue, and to the Center for Corporate and Commercial Law. Huge thanks also to the students that are here today that already had to put up with me for an hour and 45 minutes this morning. So your, as people say nowadays, your resilience is much appreciated. Also, thanks very much to the rest of the students that are here and researchers, and also to those who are connected online. I think I have a fairly big group, well, relatively big group of friends, colleagues, partners in crime for the work in insolvency connecting online. So I apologize to them for saying things that they already know, but they're kind enough to join. Anyway, so because there are so many students participating in this talk, I wanted to sort of introduce a number of introductory reflections, and I apologize for those of you who think they're too basic. Actually, otherwise, the problem is that the content of this talk might be a little bit too technical. So I hope that will not be the case, and I will be able to convey the main message that I want to convey. What I'm going to do is, notwithstanding the very unsexy title of the topic, is to provide an overview of how the treatment of financial distress and insolvency generally started to be dealt with hundreds of years ago. Well, mostly I will start from the beginning, the end of the 19th century and the models that arose in the 20th century, and how they have evolved until the moment where we are now. Things have drastically changed from certain model to transition into a completely different type of approach to business distress, which I think is quite interesting. I like to say from the start that we are far from having finished that journey. We are very much in the middle, and that's why this talk makes sense, and that's why research and doing work on this is important, because we need to ensure a transition as smooth as possible to a more, let's say, efficient or adequate system. So let me tell you a little bit about where we come from. And I think it's important that you know this so you can appreciate the change. The original insolvency system was always a system which was very formal. It was three things. It was basically collective, meaning it involved all creditors. It was mandatory. It concerned all creditors that actually wanted to receive anything out of the debtor, and it was extremely procedural. So insolvency law historically is conceived as a mechanism of enforcement, if you try to think in your own countries and your own systems, then you might, for example, in the UK, the traditional formal insolvency would be the winding up, although it has always had other proceedings around it, but that would be the classic, or the Konkursordnung in Konkursrecht in Konkursverfahren in Germany. After that was Insolvenz, La Quiebra in Spanish-related countries, Spanish-speaking countries, Fallimento in Italy, and so on. So these procedures had those three components, which are very important, and they also constituted exceptional law, which means because they were aimed at providing a solution to a situation of market failure or of exceptionality to a certain degree, they include a number of rules which are a complete change from the normal market system. And I can give you some examples here: effects on contracts, on executory contracts, stays of actions, and other exceptional remedies like avoidance of transactions and so on. So this was the classic system. This classic system took place mostly in court. So there was because it was a procedural method of dealing with the problem, it was run in the courthouse, and the majority of systems had rather inefficient, slow systems of procedural systems, and there was no exception for insolvency cases. So the situation of this traditional model was quite bad, if we think about it. I don't think there is any other area in the law in which the legal framework provides for a less successful, satisfactory outcome. So it's not only that the businesses are in trouble, it's that the whole system is non-functional and hasn't been functional for forever. And this is the main problem. Right? So it's a completely unsuccessful legal framework, mostly, however, because of institutional problems rather than design. So I've identified here very briefly some of the outcomes. It is insolvency systems, as generally described, were very scarcely used. Actually, if you look at countries, let me take the example of Mexico, for example. If you looked at Mexico, which has a relatively modern insolvency system, however, at least when I looked into it, it had like 20, 30 cases. Basically, no one used it. Does that mean that Mexico is a system where there is no business failure? On the contrary. All it means is that the system is not used because it's not perceived as useful. So there is a paradox with the numbers, with data, which is the fewer insolvency cases, formal insolvency cases, the worse the system works because the market participants just don't use it. So don't be fooled by interpreting data in this area is quite difficult. And the result is that these systems normally provided for a vast majority of liquidations. And by liquidations, I don't mean sale of the business, which is probably a very efficient way to liquidate, but rather piecemeal liquidations or sales of the assets on a breakup basis. So this is mostly the outcome. What are the reasons for this? First of all, let me just say the main reason for this failure is probably institutional. Too procedural, too rigid, too time-consuming. A business in insolvency in a courthouse is like when a car in the movies falls in the water. you see the water starts coming into the car, and the person just can't breathe. That's exactly how. So after a few weeks, unless the system is very efficient, there are very few of those. The persons inside are going to die, and this is what happens with business failure in court. So why doesn't it work in its classic definition? Creditors. Let's look at creditors, for example. Secure creditors. Well, in most countries, secure creditors for years and years, and now it's a bit less, but was the case until very recently, pretty much in every civil law jurisdiction and in several common law jurisdictions. Secure creditors had, especially as I say in civil law jurisdictions, mostly fixed security rights. So security rights over mortgages, over land, over real estate property, and security also over tangibles and intangibles, but which were fixed. It was not floating. This is coupled with the fact that most of these banks or lenders would normally have the support of their own central banks to over-collateralize. So this was not only not a problem, but it was encouraged by supervisors and regulators. Therefore, what banks would do, also because they normally have higher bargaining power, would be to require more collateral, much more collateral than the value of the loan, especially in business practice, because it's less regulated in that sense. So if we have a lender which has a large portion of the debt, which is secured with fixed assets, therefore independent completely of the success or failure of the business, and they can enforce and be fully repaid whatever happens to the business, the incentive to go into court is absolutely none. So they can enforce, and if they go to court, it will be to enforce, but certainly not to strike any deal. Let's look at other creditors, and we would make a slight difference here. Sophisticated creditors. It could also be banks, but perhaps or unsecured, and the larger the business, the more percentage of unsecured debt there is. This is very important that you bear this in mind. So if you are very small without security, you won't get a loan. If you are very large, you might get a loan without it. So it's a very different, and that matters a lot. In this category of sophisticated creditors also included those which either have security rights which align the interest of the debtor with the interest of that creditor, because there's a floating charge or because there's a pledge over the shares. So if the business is to have any value, then the shares have value, then the collateral makes sense. Or other aligned types of securities would be, as some of us saw today, security rights over receivables and the activity generally. Or more recently, those creditors which stopped looking at the insolvency of a business from the perspective of, do I have enough fixed security over assets, and therefore I don't care about the life of this business, or do I actually care if this business is rescued? And that would be because I want this business to continue to be my client, for example, and for other reasons. So that has changed. In this case, do these businesses want to use a formal system? And we did in a European Commission-funded project with some dear friends, Professor Riis-Mokal, Professor Stangelini, and others, and we came to the conclusion that, at least in most jurisdictions analyzed, these sophisticated creditors would have as the least preferred option going to court for any reason, because they would lose control. The idea of losing control because of lack of trust in the institutional framework in the courthouse was key. So they do pretty much anything not to use that system as well. So secure creditors with fixed assets, no interest. Other sophisticated creditors, no interest whatsoever. Operational creditors, of course, no interest, because if you are a commercial a creditor who provides commercial credit to a debtor, the debtor is in formal insolvency, you are not going to do it anymore. You're going to stop giving credit, commercial credit to this debtor very, very recently. And so generally, there is pretty much no one who wanted this solution and who do anything to prevent that solution from actually being used. In the case of debtors, the explanation is very evident for large debtors. There's a fear of loss of control. There's more difficulty in the negotiation of a solution, loss of investment. The same with medium-sized debtors, who are actually quite forgotten in many of the legislative reforms. But there might be a difference, though, in the case of small and micro businesses. These types of businesses might be more comfortable with a formal in-court type of procedure, especially if it's well drafted. The reason being that at a certain point, their main concern is a personal discharge of the debt. So there are social considerations involved here. So while on the one hand, they normally have a family business and therefore they're invested in it and won't do anything to avoid losing it, at a certain point, they will need to seek a discharge. So this context of let's do something about this because no one uses this because it doesn't work. So what's been done? Something's been done. This map portrays legal reform in the area of insolvency around the world. It's massive. And this is in the last, I believe it was 20 years. There are many more countries than these. There is no other area in the law, probably, apart from IT law, where there's been so many changes in insolvency systems around the world. So looking at how that happened and why is a very important part of an analysis, I think. So my thesis, and what I try to convey to you here, is that there is a process of deconstruction, of loosening the tight joints of a procedural formal system, which is going on in several stages. One first stage is the dismantling of the mandatory collective action procedure, either by selecting the parties or the system. There's stage two, which is the procedural deconstruction of the system, which is already going on as well. And the third is still under consideration in most countries, which is to not only deconstruct the law of insolvency, but laws which are not insolvency law, but which produce certain incentives to the parties that participate in insolvency, which severely influence how insolvency outcome. Right. So before that, a little bit of theory here, and this is, if you are a strange person like me and like some of the friends that are online, and perhaps also Luis and Felix, and you enjoy these things, I think we have a very brief discussion about these. When should the deconstruction start? When should we look at a sort of choice menu? Or when should we start to give options to the parties? Should we do this at the beginning? And I'd like here to revive a very old theory, which I always found extremely sexy, although not very much applicable in real life, which is that of Professor Rasmussen. Back then, I believe he was in Vanderbilt, and then he moved somewhere else. It's from the 1990s. Professor Rasmussen tried to counter-argue, tried to overcome the most dominating theory in the history of bankruptcy law, which is the theory, the creditor's bargain theory of American law and economic scholars, which was deemed some sort of Bible, which couldn't be contradicted, or you would be accused of being old-fashioned and other things. Well, it's not that Professor Rasmussen and his theory was actually not economic. It was actually extremely economic. He just challenged some of the ideas of these law and economic scholars. And he said, well, you all get it wrong, because you think insolvency law is about a mandatory collective procedure, which is explained by means of a bargain exposed. So let me explain all of this. what Jackson and Baird and others wrote this Bible in several chapters. What they said is, look, in the insolvency of a debtor, there is a collective action problem. The collective action problem mostly means that the parties should agree to behave in a way which maximizes the return to creditors generally. This was the creditors' bargain. If they got together absent transaction costs, what they would agree was the most reasonable, the most efficient solution to the insolvency of a debtor. What's that? And what they said is, well, instead of having no insolvency law, which would allow debtors to race to collect and therefore destroy the going concern value of a business, you refrain from doing this, get into a collective action so that you can maximize the value of the insolvency or bankruptcy state and maximize the return to creditors. So Rasmussen said, yeah, fine, but you got it wrong because this is not about a contract between creditors. This should be about a contract between the debtor and his creditors. So for Rasmussen, this whole thing was, or should be, a term in the contract when the debtor was formed. What he said is, when you incorporate a company, you should choose which insolvency regime would apply to you. And he produced a menu of options. So no system at all, a system absolutely tailored by that debtor, or an automatic auction of the assets, with the view of the main purpose of Rasmussen saying, well, if you do that, this is just a contract. If you do that, you will be able to choose based on your characteristic as a debtor, on your strengths and weaknesses, on the type of assets you have, on the type of business that you develop. In this case, you should know which system is best for you to minimize cost. So he said, if debtors are able to do this, then creditors will lend lower, at a lower rate, cheaper for debtor. That is the main idea of this, of Rasmussen simplifying a lot. Of course, the system doesn't really work because it doesn't take into consideration changes in the business exposed, and it leaves out non-contractual creditors. So it has a lot of limitations. But he was the first one to argue convincingly, and then after him, others like Schwartz and Hart said, we need an insolvency system which is tailored to the characteristics of the debtor. And there, I agree. And that hasn't been really developed until now, as we will see. There is a very recent paper, which I think is important, has been just published by Kanneke, Kindam, Wende, who are corporate finance lawyers, economists from German and Swiss universities, I think. And they have come up with some evidence stating that there is what they analyze is the strength of the security rights and the effect of the strength of security rights in the increase of default or crisis costs. So what they say basically is, so if you strengthen the security rights of creditors, then what this does is it gives them all the power. So as the business progresses and develops, there is a moment in which shareholders and managers started to fear, because they say, if things go wrong for me, then creditors will be able to impose a solution and get everything. And we have no way of having any value upstream. And therefore, they start investing and in insurance and other protection mechanisms, which are suboptimal from a corporate investment point of view, but which exposed would give them a better position than if they hadn't done those. In other words, what he's saying is, if you give a secure creditor a very strong right, as you approach difficulties, financial trouble, you are going to start to change your behavior, and you're going to start to make unprofitable investments to protect your position. So the extent to which this change in behavior outweighs the savings that you manage to get by giving strong protection to creditors, you should do it or not. And what they find out, although the paper is, let's say, questionable, is for small companies, for small businesses, it's best to provide very strong secure creditors' rights. For larger entities, no. It's actually inefficient to provide too strong secure transactions at the onset, because that creates misbehavior exposed. So if we get all this evidence together, the outcome would be that although there is a possibility to consider flexibility ex ante, it doesn't really work. And the reason is, if I may chip in here, I'm sure Professor Gulliver will agree with me, is that all these theories are based on the existence of a perfect trade-off between the strength of the rights of secure creditors and the automatic increase in the amount of credit available and the lower price of that credit for debtors. So the stronger the mortgage, the stronger the pledge, the cheaper I'll have access to credit, even within insolvency. And that is just not how things happen in practice. In real life, if I go to a bank, ask for a loan to finance my business, and I say, well, I'm not going to give you an security right, but you should feel free to charge me more interest rate. What will the bank say? The bank say, I'm not going to give you a loan unless you give me a security right. So this is just not true. It's not how it works. It's sort of a Hobson's choice for the vast majority of debtors. So this automatic trade-off is not correct and therefore doesn't work very well. Anyway, what these guys got right, no doubt, is the fact that uniformity doesn't make sense. That insolvency systems have to, and that's been going on, have to be treated differently depending on the type of debt. Why? Many reasons. First of all, there are differences of information that these debtors provide to creditors. The smaller the business, the worse the information that's available, and therefore the more difficult the decision-making process. There is a difference in asset structure. Believe it or not, if I'm sure you'll believe it, the less tangible the assets of a business, the more costly the credit will be. So that also matters a lot. The technical capacity of the debtors is different depending on the size and the complexity of the activity. The incentives of debtors are different depending on the size again. If it's a family business is one thing. If it's a business which has outside investment or is a large corporation, let alone that, the incentives of managers and the parties may vary. And so there is a lot of evidence concerning types of debtors, types of behavior inside and outside of insolvency. And I copy here a very small set of conclusions, which only concerns European countries. But this is basically based on BBVA and ECB data. It says that micro businesses have mostly secure debt at the top with just one bank, higher percentage of tax debt than any other type of business, and a ratio equity debt which is higher than bigger entities. So this is the structure of creditors. So on the one hand, we've seen the differences in the way assets are and behavior of debtors, but the change also happens on the creditor side. Creditors, depending on the type of debt, are completely different. And therefore, you can't provide a one-size-fits-all type of procedure. For medium banks, you have that there is one or two banks, but these are the ones that resort to bank debt most generally. and labor law liabilities increase in this type of debtors. In the case of large entities, the data available states that much of it is unsecured, and that there are bond securities issued, and there are several banks involved. So a lot of highly sophisticated creditors sitting on the table, and that makes a big difference. So if we have different incentives, different assets, different creditors, how can we ever propose the same insolvency solution? It just doesn't make any sense. And Rasmussen said it, and he was right. And I think at this stage, everyone must admit that this is the case. So the main outcome of this analysis was, and this is the insolvency project that we prepared for the European Commission, was for large debtors with a structure of creditors like we've seen there, the best solution is to be flexible, is to let the parties work, because they're repeat players, because they know each other, because they are sophisticated and they are going to maximize value. So let's provide a system which is not necessarily too hard, too rigid, and too procedural. In this context, the deconstruction stage one, and I'm afraid I'm going to have to speed up a lot. The deconstruction stage one is doing away with the mandatory requirement. For Rasmussen, insolvency law was not mandatory. It was a contractual clause. Therefore, it was a default regime. The parties could agree to something else. Legislators over the world haven't gone that far. But what they have done, and this will be very familiar to all of you, at least to those of you who are well versed in English law, is the possibility of loosening the solution by including a procedure where not all creditors need to be involved. So it's not mandatory for all creditors, only for those that are chosen to participate. So the idea of this procedure is of loosening this first degree of deconstruction is we won't get all creditors on the table, only those creditors which we want to negotiate with, which would be banks, bondholders, and some strategic creditors in executory contracts, lessors, blah, blah, blah. We will not include here operational creditors, meaning suppliers and so on. Those will be paid in full while we negotiate. And we also won't include non-adjusting creditors. We will not negotiate with tax authorities. These things are normally left outside. So the way to deconstruct and find a solution is for large entities, because this only works for large entities, is let's cherry pick the creditors that will participate. This flexibility is key, and it started in countries with floating charge systems, but now is spilled over to many other countries. And this is actually now perhaps the most successful system of dealing with insolvency for large entities all over the world. And here, of course, I'd like to highlight the schemes of arrangement, which are the first, perhaps, system that had this approach. Schemes of arrangement, which, as we were mentioning before, by no means was created as an insolvency procedure. But operators in the market in England realized that the system that they had envisaged for takeovers and for other corporate transactions could be very well used also for a flexible way to restructure debts. And they used that. What's the main advantage of this type of procedure? Low or no reputational damage, so the going concern value is preserved, and the decisions, this is very important, are adopted by the best monitors. And who are the best monitors? The best monitors are normally sophisticated creditors who know the business, normally lenders. So it's okay. All right. So, okay. So I just say that while this first level or stage of deconstruction is very important, this stage of deconstruction has its problems too. And the reason is that this type of restructurings, which don't involve of creditors, this is done on the basis that non-participating creditors will be respected, and therefore their liabilities won't be restructured and they will not suffer any damage. But there is a problem with that presumption. The problem being that these type of agreements not only restructure liabilities, they also restructure the assets and the business often. And therefore, what happens in these proceedings is there is really a restructuring of the whole business as a going concern, which therefore affects the ability and the level of risk, therefore the ability to be repaid in the future of creditors who on its face were not affected because they were not called to the procedure, but in reality they could be accepted by modifying the business. So this is a problem, and there are different ways through which this is tackled, but we don't have the time to go over them. Just bear in mind that this is something which needs to be looked at. It's not as easy as say, I don't need to include you in this negotiation because I'm not going to touch your debt, because ultimately the risk of repayment of the debt is altered. Second two, very important, this is happening. And this is, even if we must have a formal procedure, therefore, in a way, go back to the old model and provide a solution to the business financial distress in the context of a courthouse, as we saw, might have been interesting for small debtors. In this case, there is a way to provide, to deconstruct the procedural structure of this insolvency system, because procedurally that was part of the main problem. Things were too slow and value destructive, but there is a way to loosen the procedure in a way which is much more flexible and which entails fewer costs. And this new approach to procedure, which is very similar to what happens in the US, especially in Chapter 11, is a procedure, but it's not a formal procedure, is the future procedural law in insolvency proceedings. What will be the main terms of this second wave of deconstruction of that initial formal level? First of all, a modular structure. And for this, my colleagues, Gianni Sara, Ron Davis, Rizmo Calvar, Romain, Edith Mevorak, Alberto Mazzoni, and others should be credited. We came up with the idea of this modular approach, which has been now adopted in at least considered for adoption in international instruments. The idea would be a procedure is declared, and as unlike was usually the case, where automatic effects happened and there was no way to choose them, in this new procedure, things are different. The parties who will be the ones that will bear the cost will be the ones that will select, as if they were modules which were unpacked from a core, which effects of an insolvency procedure to select, to use in one system. For example, it will not be mandatory to have an insolvency practitioner appointed. It will not even be mandatory to have a stay of enforcement. Only if the parties so request and are prepared to assume the costs, these modules will be selected by the parties. So it's a way to create some sort of menu within a formal insolvency procedure, which has the benefit of adjusting to the circumstances of the debtor and substantially reducing the costs of the system. This might seem obvious to you, but this is a revolution in the way procedural law is used, at least in civil law countries. So this is something which could be very important. The idea behind this structure is that parties are best placed to select the tools appropriate in each case. and therefore several rules are included in the decision-making process of these procedures, according to which, if there is, for example, creditor passivity, the creditor will suffer the consequences of that. This is especially important in small businesses where, for example, banks don't take interest in the case. If you don't take interest in the case, then a plan might be imposed on you because your silence will be deemed a positive vote in a plan, to give you just one example. The lowest institutional involvement, of course, automatically entails lower costs. And as I'm sure you realize, this is key, especially in insolvency cases for very small debtors, where there are no assets left in the case. Finally, the game changer, which is part of this new generation of deconstruction of the system, is IT. Even in formal procedures, auctions will be held through platforms, the sale of the assets through online platforms, which can be accessed by everyone, not just by bidders in an auction. Notifications will be done electronically. All this drastically reduces the cost of procedures and enhances transparency, and therefore is a huge, massive improvement as compared to a traditional procedure. Deconstruction stage 3, and I'm finishing really. All of this is lovely, but won't work unless a new stage in development actually is considered. And you can't just change insolvency law if you want to have a good insolvency system which is working. You need to change other areas of the law. One of them, for example, in many countries, not in the UK, but in many countries with less sophisticated systems, is a massive improvement in the financial information available for the parties. While some very sophisticated creditors can access adequate financial information, ordinary creditors will not. And therefore, the reliability on the financial information provided by the debtor is key in the adequate and efficient decision-making process. So that needs to the system needs to be bolstered at this end too. And perhaps the most important one is the adequate regulation and supervision of the banking system. There needs to be a way in which a balance is struck between what's reasonably supervision of the banks as creditors, saying you don't incur too much debt, you don't behave too aggressively, you adopt a decision which not only is short-sighted, but actually sees the investment as one which is worth rescuing a business which has going concern viability going forward, instead of just enforcing and other elements which do not have to, they're very, very important. We don't have the time to go over. So take my word for it. There is absolutely no way an insolvency system will work no matter what you do if the banking regulatory system is not adapted to it. And this is very difficult to achieve in practice. So some conclusions: the deconstruction of a classic formal system is very much underway, but we are in the middle of the process. We are going to need to encapsulate a system which protects mechanisms as the schemes of arrangement, for example, which provide plenty of flexibility for larger debtors, but which corrects some of the deficiencies of the system. We are going to move towards a system in which the type of procedure is defined by the size, age, type of maturity, so by the circumstances of the debtor. We need to drastically transform or continue the process of transformation of procedural systems, and we need a complementary reform to other parts of the law. If we complete the process in a few years, if not decades, we will have finally completed a system in which the market will work adequately, also at its darkest end. So we're in the process, and we get there at some point. If you think your country has a system of insolvency which works great, you're wrong. All of you. I don't know where you're from. You're wrong, because while you have a system which might work well for large debtors, I don't think anyone in any country has a system which works well for all debtors. Not at all. So sorry for that. I thank you for your patience.